Hey guys, Omar Khan and welcome to Stock Market 101. Everything you always want to know about the stock market and the options market. Don't go away. We're going to be talking about amazing topics. Why does the stock market go up? Why does it go down? What affects that? And then we're going to start looking at why most mutual funds don't even beat the stock market every year and how that's costing you hundreds of thousands, if not millions of dollars over the course of your lifetime. And then we're going to talk about a proven way to beat the stock market. Selling options. Don't go away. This is exciting and it will change the way you think about investing. Hey guys, welcome back. Omar Khan, yours truly. Today we're going to be talking about Stock Market 101. We're going to talk about 3 proven ways that you can beat the stock market. Now, we talked about in the last episode, the S&P 500 over the last 50 years has returned about 11% a year. It's pretty good. If you just leave your money there, close your eyes, don't worry about what's happening in the world, over the last 50 years, you got 11%. That means your money is doubling every 6.5 years. That's a great place to be. Now, we also talked about how the typical mutual fund that invests in the stock market loses almost all the time. They lose, in fact, over 90% of the time. That doesn't mean they lose money. That means if the stock market did 11, they might do 9 because of a management expense ratio, and they're looking too much like the market. The market holds 500 stocks, the S&P 500. The typical mutual fund holds 200 to 300. And this is going to cost you, and watch the last episode if you haven't had a chance to, it's going to cost you hundreds of thousands, if not millions of dollars over the course of your investing lifetime. So now let's talk about how can we actually beat the stock market? Well, first thing we talked about is the typical mutual fund in Canada holds 200 to 300 stocks, okay? And that's a US-based mutual fund which invests in the S&P 500. And the S&P 500 has 500 stocks in it, the 500 largest companies. And mutual fund has 200 to 300 of those same holdings. So if the stock market does this over time, 11%, and that's what it's done over the last 50 years. Your typical mutual fund, because of it's going to look just like the market, it's going to perform almost the exact same. But what happens over time is that the returns start deviating. And they start deviating because when you look just like the market, you're going to act just like the market. And then you minus your management fees and you're going to lose to the market. That's going to cost you a lot of money. So what is the solution for this? Well, I'll tell you what we do here at Theta and the way that I've invested over a number of years. First thing is concentration. Excuse my handwriting. Concentration, okay? So instead of being like the typical mutual fund in Canada holding 200 to 300 stocks, we want to hold about 20 stocks. That is the first thing you want to look for in a good fund, in my opinion. 20 holdings. So holdings. Approximately 20. Okay? It could be a little bit more, a little bit less, but you don't want anywhere near 200, 300, or 150, in my opinion. Why? Now, why is this important? Well, if your fund holds 20 positions, that means each position is meaningful. And you're not going to perform like the market. You might pick the best 20 stocks or really good stocks that perform better than the market. The idea when you invest in a concentrated portfolio is to thoroughly analyze the companies that you invest in. Now, we talked about this. A stock goes up or down long term based upon the amount of money that company makes. So if you invest in 200 to 300 companies, it's really hard to make a difference. But if you invest in 20 companies, and you've predicted that those companies are going to make a lot more money, you have a very good chance of beating that at 11% return. That's important. Now let's look at some empirical evidence. A couple of great investors historically. Peter Lynch ran the Magellan Fund in the United States for a number of years. Performed almost 30% a year. He only held about 25 positions. Warren Buffett, the greatest investor of our lifetime, he holds a small number of companies. Now, if 2 amazing investors, and arguably the greatest investor of all time, is using a concentrated portfolio, is that not something you should be doing? So first thing is, look for a fund that has a small number of holdings. That's a pretty good number. Now, also, you talk about diversification. Well, there's a lot of studies showing out there that after about 20 stocks or so, you don't get a lot of diversification. So if you hold 30 or 40 or 50 or 100, you're going to have similar diversification as holding 20 stocks, as long as you're spread out over a number of different sectors, like the S&P 500. So the first thing like I said, you want to be looking for is you want to look for a fund that is investing in a small number of companies and understands those companies thoroughly. Now, when we invest in companies, let's say, for example, we invest in Tesla. It's one of our top holdings, one of my top holdings personally, excuse me. Now, again, that's appropriate for me. Does not necessarily mean it's appropriate for you. That's not meant to be stock advice. Now, I own Tesla. That means I've analyzed the company thoroughly. I've had a good idea as to how much money it's going to make in the future, and I can apply a decent multiple, then I can project out what I think will be the long-term value. I also drive a Tesla. I constantly go to charging stations and speak to owners. I look at experiences. I watch videos on it. I know their new products coming out. I know their margins. I understand the company very thoroughly, so I'm very comfortable investing in it and putting a decent amount of money into it instead of spreading it out over 200 to 300 stocks. So that's the first thing, concentration, okay? Now, the second thing we want to look for is we want to sell options on those companies. Now, we're going to do an episode that's going to be entirely dedicated to the benefits of selling options, but I'm going to get into it just briefly with you, okay? Now, let's say, for example, Tesla currently is trading at $200, okay? And I think in the years ahead, it'll be worth more, okay? A lot more, okay? And this is why you do your analysis. You do your projections, and you kind of figure out what the value will be in a number of years. So I certainly don't mind owning it for 200 if I think it'll be worth more in the future. And again, that's my opinion, not meant to be stock advice. Okay, so what do? We have two choices. One, we can simply buy Tesla at $200 and sit on it and wait for years and years and years. And that's a good plan if you believe in the company. Nothing wrong with that at all. Buy and hold. It may be a cliche, but it works. Now, the other choice we have is we can do selling a cash secured put. Let's just go cash put. Now, I know that sounds like a mouthful. What exactly is a cash secured put? Well, that means instead of buying Tesla, I'm simply going to agree to buy Tesla. Let's say instead of buying Tesla for $100 and $200, which is where it's currently trading at, I agree to buy it for $190 for 30 days. 30 days, okay? Again, my apologies for handwriting. We're going to agree to buy Tesla for $195. That's called a cash secured put. And the cash secured because we have the money in case we have to buy it. That's very, very important. If you don't have the money to buy that stock, don't put the order in. Now, if we simply agree to buy it for $190, we might get paid like 2 or 3% a month, depending on the volatility, which means how much does it do of that? The more it does of this, the more you get paid. So I know it's a weird concept to understand, but it's an absolute game changer when it comes to investing. I'm going to agree to buy Tesla for $190, and let's say I get paid 2.5% for the month. So what's the worst that'll happen to me? Well, there's two scenarios that can occur. One, Tesla stays above 190, and I keep my 2.5% for the month. Great. Or scenario two, Tesla goes down below 190, in which case I will be forced to buy Tesla for 190. Even if it goes lower than that, I'll still be forced to buy it for 190. But I'll keep that 2.5% no matter what happens, okay? So sometimes I might have to buy a stock, sometimes I won't. But the point is, I was gonna buy it anyways at 200. This is just a way for me to get paid a lot of money to buy it cheaper. So that is the concept of selling a naked put. Now, this is again one of the few proven ways to be able to get an edge up on the market is by selling cash secured puts. Don't go away. We'll be right back. We're going to talk about a lot more things. Stay tuned. Welcome back to Stock Market 101 and 3 proven ways that we can get an edge up on the market. Now, the first one we talked about is we want to have a concentrated portfolio, okay? Instead of having 200 to 300 holdings like a typical mutual fund, we want to look for funds that have 20 holdings. Why? We went over concentration is something that works if you understand and invest in the right companies. Second thing we want to do is we want to sell options on this. So we talked quickly about how to buy Tesla for cheaper. So we could have bought Tesla on the open market for 200, but we agreed to buy it using the concept of called selling a cash secured put. Now, if you'd like to Google that, watch some YouTube videos. I will do another episode on this topic in a lot more detail. It is an absolute game changer. It'll completely change the way that you invest going forward. Now, what we've done here is we've simply agreed to buy Tesla for 190, and we got paid 2.5% for the month. That's a great deal. I'll take that deal all day long. For me, it's just free money. So we talked about concentration. We talked about selling options. Now, let's take a look at a few other things. In that scenario where we had to buy Tesla, and let's say we agreed to buy it for 190 when it was at $200 and it went to 185. Okay, well, now we had to buy it. And these things happen. The market goes up and down a lot in the short term. But the reason we don't mind is because we've already done our homework. We think it'll be worth more in the future. So let's say we had to buy Tesla at $185. Now keep in mind, we probably got paid about $5 a share because we agreed to buy it for 190. It's a great deal, right? Why wouldn't I take that deal? I'll take that deal all day long. Now what can we do if we have to buy it for 185? Well, there's something called, and this is a great income generation technique, it's called selling a covered call. Now, selling a covered call is this. Why is it covered? It's because we own shares of it already, so it's covered, okay? And by the way, I didn't come up with these terms, naked puts and covered calls. These are industry terms. It's interesting how they came up, but it's a covered call. So, what we're gonna do is we're gonna agree to sell our Tesla shares for $210 for the next 30 days. Okay? Now, that's something called a covered call, like I said. And what we might get paid for that month is something maybe around the vicinity of $3.60 or 2%. 2% for a month simply to agree to sell my shares for a profit? Again, to me, that's free money. I'll take that deal all day long. But I'm going to go into a little bit more of a topic called seasonality and why you may not want to sell covered calls in the traditionally strong period of time, which is from October to May. So selling options, specifically selling options, it's historically proven that 95% of the time, the person who's selling an options wins that trade. So we don't buy options, we sell options. And again, I'm going to do another episode on this, a lot more detail. If you have any questions at all, please feel free to reach out to us. Be happy to answer your questions. So, naked puts, covered calls, that is selling options. It is a great way to generate income and buy your stocks for cheaper, stocks that you already wanted to buy. Now, if you don't want to get into buying stocks, what you can do is you can do this also on an ETF. Let's take, for example, a SPY. What is an ETF? It is an exchange traded fund. Okay, that is the acronym. This is the symbol. SPY is the exchange traded fund for the S&P 500. You know, the one that's done 11% of the year for the last 50 years. So you can invest in the 11% in the S&P 500 for a very, very low cost. Instead of investing in a mutual fund, which looks just like it is charging you 2%, you might be able to get into this at less than 10 basis points, which is 1/10 of 1%. So it's not going to drastically affect your outcome in the long run. And this is why a lot of people who are savvy investors are moving towards ETFs and cutting out the middleman, because the middleman has proven to lose over and over again to the index. So you can sell cash secured puts, you can sell covered calls on that ETF. So if you don't want to look at individual stocks and analyze a Tesla or an Apple or a Royal Bank or whatever it may be, well, why not just do it on all 500 companies? This way, the worst that happens is that you own the S&P 500. If you don't mind owning the S&P 500, especially at a lower price, not a bad deal at all. So that is the second proven way to beat the market. Now, we're going to talk about the last way that we know that really helps with getting an edge up on the market. That's called seasonality. Seasonality. There's an old saying in the stock market, sell in May and go away. I'm not sure if you guys have heard it, but it's pretty popular in the industry. What does that mean? That means the stock market, I'm going to show you a study on the S&P 500, generally does pretty well from October 27th to May 5th. So October 27th to May 5th equals positive. Okay, so what does this mean? That means the rest of the time from May 6th to October 26th, stock market, it's more flattish, okay? Now there was a study from 1950 to 2019, that's 70 years of data on the S&P 500. And this is how important this is. If you invested $10,000 on May 6th of every year, and you pulled it out on October 26th of every year, so you put it in May 5th, when sell in May begins, and you pull it out just before the seasonally strong period of time starts, your $10,000 over 70 years would be valued at $8,600. Not so good. You actually lost a little bit of money. And that's not counting expensive mutual funds, that's just investing in the index. Now, had you done this for the exact opposite period of time, every year, invest on October 27th, pull your money out on May 5th, your $10,000 would have grown to $1.9 million. It shows you how important investing in the seasonally strong period of time is. So what does that mean? That doesn't mean the stock market's very poor in the summertime. It just means it's kind of flattish. So what does that mean? Well, that means we can sell a lot of these things called covered calls. We can agree to sell our stocks for a profit. If they happen to go up, great. We know statistically that's not too likely, so it's a great way to generate income over the summer. And the two worst months of the stock market are September and October. Those months, again, we can be aggressive in selling covered calls and generating that monthly income that we want. Just keep generating. Worst case scenario, we have to sell our stock for a profit. Not a bad idea. Absolute worst case scenario, we own a bunch of companies we like, or the index. So in the winter months, again, you want to have a concentrated portfolio and you want to be selling cash secured puts. Why? Because the tendency for the market is to go up. So you can make a lot of money simply for agreeing to buy the stocks that you wanted to buy anyways at or just below its current market price. And this really starts to add up. So you want to take all these things into account when you're looking to invest. At the end of the day, it's all about financial literacy. Understanding how the stock market works and how to use these three simple tools, these three simple lessons into your everyday investing will make a massive difference over the course of your lifetime. I'm happy that you guys have understood this now. If you have any questions whatsoever, I'd love to take you up on any questions. You can look at the email address below if you want to send us an email. And in our next episode, we're going to delve a lot more deeper into the concept of selling puts and calls to generate us monthly income and have a nice, steady source of income coming in over time. See you next week.